All right, check, check, radio check. I want to thank everybody for taking time out of their busy schedule to sit down with us and do our weekly chat with Chris. Yeah, we'll have some people that are watching on LinkedIn. Some latecomers will come in, but if you've not been on this call before, basically, what I do is every week touch on some financial topic so that we can educate the public, help you make better decisions. So part of that is everybody is always looking to, get tidbits and nuggets of wisdom on what's going on in the marketplace. So, our financial planning team helps me to put together slides and data that allow us to convey information. And it's a rear view mirror look. So, quite often we'll turn on the TV and we'll hear, the talking heads, and everybody says, hey, well, the market's going left, the market's going right. And, they're trying to forecast. And, really the purpose of our presentations is to be able to do a rear view mirror look, to be able to say, hey, Monday day quarterback, based on what we've seen just happen, what are the indicators telling us? What are the signals, or if we're flying a plane, what are the gauges telling us, right? So without further ado, if you've not seen this chart before, this is a monthly snapshot of equities. And they're different colors here. And we have a zero line here in the middle. It says 0%. And then these are indices, right? ETFs that have a basket of stocks, and they're all color coded. So if we look here, what finished for the month, we can see that the light blue, right, is European countries, right? So that's MSCI EAFE, which is Europe, right? So basically Europe and the S&P 500 ETF both finished up the month positively and with a little bit of fluctuation. So we had a good month. Everything did pretty well. We had a tail off with emerging markets. So that's, I always think of emerging markets. You'll hear me refer to that, typically like China, up and coming countries, third world countries that are maybe not as economically sound. And then lastly, we have the hot pink, right? That's commodities. And typically, I think of precious metals and I think of petroleum products, right? So, right now it's with some of what's going on, in Iran or whatever, commodities have slowed down a little bit. So, it's the commodity indicators have a large holding of gas, petroleum, natural gas, and oil, right? So all those things combined, just it's volatile. It has its moments, but right now for the month of May, it did not do well. But 1 month does not a market make. So we typically try and talk about here is, let's look at since the beginning of the year. And as we're 6 months into it, this is June, but we are looking at May. And now we can see that, hey, the S&P has really, done well. But I caution, because, this is where timing the market has been proven time and time again to be next to impossible. And, if you had followed traditional advice from the talking heads that, hey, the market's going to correct, the recession is looming, be careful, right? You would have missed out on this upward trend. Now, a lot of that is coming from, a few stocks, right, that are helping to pull and maintain this upward trend, one of which is NVIDIA. I have a client that recently just went out and bought NVIDIA, and I encouraged him. I applauded him because, he had never really owned stocks individually. And as I turned around and I started to say, hey, you should own stocks, but this does not make a retirement plan. And I just want him to become familiar with the fluctuations. So, but I do think that in the immediate time frame, I think NVIDIA is a good play, and I think it split 10-1 on Monday. That being said, I remember, and I was talking to somebody yesterday, that AOL back in 2000, everybody loved AOL. It was everybody could not get enough of it. Oh, my AOL, I'm going to retire early. Everything's great. And then we had the internet bubble burst back in 2000, right? So people found out the hard way, and that's why that old adage that all your eggs cannot be in one basket. So when we look at an index like the S&P, the Spider or SPY, that they 7% of this ETF is made up of Nvidia and its upward trend. So it's probably likely to continue because everything that's AI related will need some type of computer chip. But at some point in time, that momentum could change. So this is why diversification is such a found and fundamental principle of proper retirement planning and financial planning. So as we continue down, now we see the commodities, and that's again because you have war in the Middle East. You have Iran, Iraq, some of these oil producing companies are countries that are saying, hey, listen, we hold all the cards right now. So although May was not a great month for commodities for the year, it's done okay. So again, we saw in 2000, 2001, we saw some volatility there, and just be careful. The next one is the light blue, which is again the European nations right here, 7.74%. Europe's starting to recover, and then we start to tail back a little bit with the neon green, and so that's emerging markets. And again, I just typically will refer to that to like China, Indonesia, countries like that. The purple, we have the spider, that's the Dow Jones. Dow Jones are typically dividend paying stocks. And, we're going to actually have a call next week, I think, on dividend stocks in general. So it's been a while since I've talked about that. So stay tuned. Gold, we have the Russell, that's small caps. And that's a little concerning to me because, again, you have for the whole year, it's just showing me as I look at this chart, I go, part of the heartbeat of America, which is small businesses, are under pressure right now to create some type of growth, right? And that's because of inflation, for the rising costs of hiring workers, and minimum wage increases, the cost of gasoline, right? All these factors have a trickle down effect, and I think that's sort of evident with the Russell there. And then you have obviously the gold, which is real estate, and I think real estate will continue to be under pressure because since COVID hit, you'll have a lot of commercial real estate that is actually has uninhabited office space, and that never does well for investors that are looking to get a return for their investment. So now that we've looked at the month and the year, this is what we call our three wise men. And it's really three indicators. So the top one is RSI, Relative Strength Index, and that's a momentum indicator. So it's how quickly things are changing, and when should we enter. You'll see here that we have a green line all the way to the right. So that just means that all three of the indicators have a line. So you have the RSI is the top one, right? And that's using a 3-month and a 12-month moving average. And the crossover is saying, hey, listen, the short-term indicator is up and above the longer term, which should pull up the average, which is a good signal. Then you have moving average, right? So you have your typically your moving average, which is a 30-day and or 90-day and 12-month, is again has tripped because now it's saying, hey, we should be pulling up that short-term line. And then lastly, we have the MACD, the moving average convergence divergence is a momentum indicator, and it's just saying, hey, listen, it just it helps us to time the market of when we should get in or get out, right? So all these things here are basically just saying, hey, we have a green light. That does not mean that we should not issue caution. And I was thinking about this. If you've ever been to the beach and there's a hurricane coming, you will see the lifeguards put flags out of different colors. And I'm probably going to talk about this a little bit next week as well. And that's, if it's red, right, don't go in the water. If it's yellow, be careful. If it's green, you'll be fine. So right now, my personal opinion is that we have a yellow flag. I think that there is so much risk on the horizon that I think that we have a tinderbox here, that this could very quickly turn around. So don't be lured in with the false sense of security that everything's fine. We have an election year this year. You have Israel still, in conflict, and now it's, between Iran and Hezbollah and Hamas, right? They're just being pummeled, and their attention is full with that conflict. Then you have, Russia and China with Taiwan, and just all the things that are going on in the world. It will only take one or two of these events and the election, right? So if you're overly complacent, I think you could find out the hard way that your portfolio could lose value and have risk. So just be careful. Again, this is a Monday day quarterback look as to what we see. And I'm just trying to say, hey, I want to, in all my clients, we are still have green lights, but I'm getting ready to issue some cautionary flags, just saying, hey, let's be careful. Let's take some risk off the table. Let's try and put some things in place that will allow us to keep what we have, so we're not digging out of a hole. Now we're going to get to income, right? So if you're in an income portfolio, and again, we'll look at, for the month, if we look at this zero being percent, 2.88, which is green, which is 20-year treasuries, right? So that just tells me that there's a flight to safety. So other people, other investors are feeling, hey, for the month of May, that they're being cautionary, and that's why money would gravitate into that area. And then you have investment grade bonds, again, flight to safety. But remember that income portfolios are about yield, right? If we have $1 million and we were told that our $1 million could yield, 6 or 4%, right? Right? That's 60 grand or 40 grand, right? Well, if you need that to pay your bills and not eat into your principal, you're in for a rude awakening if all you're getting is 2.88 or $28,000 or $22,000. I mean, where's the differential come from? Right? And again, 1 month. But let's look at what the year is for year to date. So now when we look at it, all income portfolios have been under pressure. And that's because the Fed, right, has raised interest rates, and bond portfolios, they have an inverse relationship. So now what we're seeing is the Fed has said, you know what, we're maybe going to pause. So the yields right now you're actually eating into principal if you had to basically needed that money to consume or to maintain that $40,000 and you didn't get the $40,000. Now in order for you to get your $40,000, you're actually at a -1, and that's for the Vanguard bond ETF, right? So that's a total return bond fund. That's international, right? So you're looking at that and going, okay, that's where my money is. But now I'm having to eat up 5% of my portfolio in order to maintain lifestyle. So it's taking that into consideration is just when we're looking at bonds, if you've been on this call in the past, that bonds are that one sort of, I think, variable that a lot of people, most financial planning software will say, 60-40 split bonds or 50-50 equities bonds. And what I've often counseled with folks is having bond alternatives. What can we do to eliminate some of the safe money risks? Because this was always deemed to be safe. And yet here we are in an environment where bonds are actually dragging down our portfolios or adding an element of risk and uncertainty. So, again, this is just our observation. And then again, you see a negative yield on the overall -7% for treasuries, but you may start to see that this is a place, a safe haven, where people start to flow money in to sort of say, hey, I'm concerned about the overall geopolitical risk that might be out there. So, again, it's a lot. I don't have a crystal ball. I'm just telling you what I see when I look at this and I go, look, if you were my client and we had decided that we needed 4%, and I just had this conversation with somebody that is, I helped their 3 kids, they had triplets, get through college without going broke. And now we're revisiting because they're ready to retire. And they were able to do it because we didn't pay retail for college. Well, now that we're looking at their portfolio and they ask me, well, why should we consider an annuity versus a dividend paying stock basket? And that's why I'm going to have the conversation next week on how creating income portfolios, whether it be from equities or whether it be from bonds, either way, what are the pros and cons of doing so? So hopefully you'll join me next week as well. And now this is for the U.S. bonds, right? So the AGG is U.S. bonds, and again, we have a green line. So this here says, hey, listen, bonds should recover. So if your portfolio, I'm not telling you to go out and sell the bonds in your portfolio. That would be a mistake. Actually, what this is indicating is that the bond portfolio should start to heal from a valuation standpoint. But from an income standpoint, I still think there's pressure based on the chart that we just looked at. So again, bonds are an area that we have to keep an eye on. And as you can see, in 2021, 2022, if your portfolio was up here with this red line and this happened, and now you've lost a huge percentage of your portfolio, and if that portfolio was needed to generate income, I think you'd be under a lot of pressure. So just keep that in mind. Lastly, this is what we call our recession probability analytic tool. This is proprietary software that they had created. And, basically it just says anything above 50% shows that a recession could happen in a 12-month going forward pace. So right at the cusp, there's nothing, the sky's not falling. I'm not Chicken Little. I don't think that everything's going to crash and burn, but it is higher than what it's been in the last couple of years. And so it just causes me to go, let's be careful. Let's not make the mistake of having all of our assets or all of our retirement planning assets in a position where we're turning around forced to work longer, right? That all of a sudden I wanted to retire at 62 or 65 or 67, and now I'm forced to retire later because I don't have the income coming in or I lost valuation of my holdings. So that's what we do at Professional Planning Services. We try and help you to identify risk and other things that you should be thinking about. Lastly, I want to invite everybody. We're doing our next Social Security seminar at Rutgers Business School in New Brunswick. It will be in the South Building, which is this little lower right-hand side here. This building here, we have not sent out the mailing and the invitation, but I just had two people that were not able to make the last one register. So Caitlin's out this week on vacation. So we're going to be starting to promote and not only do a mailing to the local community. There is no cost to attend this. This is educational. We're not selling anything. But what we found is that by helping folks understand the complexity of Social Security and why it's such an integral part of your overall financial plan, you should educate yourself, because quite often people make mistakes that are leaving them hundreds of thousands of dollars behind, or they're missing out because they've made incorrect elections. So we're happy to help. So if you want to do that, let us know. And then lastly, this is our compliance chart. So we have to play this for to cover our bots.